They told you this was just another holiday rally. They told you the spot price on your screen was reality. Tonight, that script is dead. As of January 5th, 2026, 4 p.m. Eastern, the panic is no longer a rumor in chat rooms. It has climbed all the way up the chain of command and walked straight into the Pentagon. For years, we said the day would come when the people who print the money and command the armies would finally admit one simple truth. You can print dollars. You cannot print silver. We said that when the physical shortage became undeniable, they would not sit back and watch the paper market implode. They would move to seize supply. They would move to secure atoms, not promises. Well, that day is no longer theoretical. It has a contract date. It has a dollar figure. It has coordinates on a map. Around December 15th, 2025, while you were thinking about presents and plane tickets, the United States government quietly signed one of the most significant metals deals in modern history. The deal is simple on paper and devastating in its implications. The U.S. Department of Defense and the Department of Commerce partnered with Korea Zinc to build a massive critical minerals processing complex in Clarksville, Tennessee. A total project cost of roughly $7.4 billion. The first new non-ferrous smelter of this scale on U.S. soil since the 1970s. For 50 years, America was perfectly happy to dig rocks, ship them overseas, and buy back finished metal from China and a handful of refineries in Asia. We exported the dirty work and imported the clean product. That era is over, because this time, the U.S. government did not just sign a supply contract, they took equity. The Pentagon will own roughly 40% of this project. Not 40% of the offtake, 40% of the entire strategic machine. Let that sink in. The U.S. military is no longer just a customer in the metals market. It is now a co-owner of a smelter designed to process about 1.1 million tons of feedstock a year, producing 13 non-ferrous metals, 11 of which sit on America's official critical minerals list. Silver is right there in the cluster of strategic outputs. What does that mean in the real world? It means the silver, zinc, indium, gallium, germanium, and the rest of that periodic table cocktail are not being prepared for you, for COMEX, or for bullion banks trying to hold down the chart. They are being pre-allocated at the ownership level to strategic stockpiles. The atoms are spoken for before the ore even leaves Latin America. That's the part the paper traders can't process. They're staring at futures contracts. The Pentagon is staring at missile guidance systems, satellite constellations, radar arrays, and power electronics that physically cannot function without high-purity silver. You can't melt down a futures contract and solder it into a Tomahawk missile. You can't bolt an ETF into an F-35. This is the core of the spot price lie. The number on your phone is a number inside a casino. The number the Pentagon cares about is measured in atoms per warhead, atoms per satellite, atoms per solar farm. And when those two realities diverge, the paper must submit to the physics. But here's where the story goes from big deal to break the system. Because the United States did not make this decision in a vacuum, they made it while watching the same thing we're watching tonight, the Shanghai breakout. Right now, as I'm recording this, the Shanghai Futures Exchange is printing around 18,420 yuan per kilogram for silver. At an exchange rate of about 7.1 yuan to the dollar and 32.15 troy ounces in a kilo, that is not $75 an ounce. That is a live price in the $80 zone, roughly $81 to $82 per ounce. So on one side of the planet, New York is insisting that silver is worth about $75. On the other side, Shanghai is paying $7 more for the same metal. In a world where high-frequency traders will knife each other for a 1 cent spread, a $7 spread is not an anomaly. It's a crime scene. That spread is the disconnect. It is the market's way of screaming that the Western paper price has lost control of the physical flow. Now imagine you are a global metals desk at a trading house. You're sitting on vaulted bars in London or New York. You see $75 on COMEX, 82 in Shanghai. Do you sell to New York out of habit? Of course not. Any junior analyst who tries that gets fired before lunch. You book freight. You put that silver on a plane or on a ship and you send it east. You sell into the higher bid, lock the arbitrage, and you never look back. This is no longer a market. It's a hydraulic lock in the global plumbing of silver. Pressure is building on the Shanghai side of the pipe, and the only way it can equalize is by sucking every unencumbered ounce out of Western vaults and draining it east. Every bar you thought was available in New York is now a potential pressure relief valve for Shanghai. And Washington can see that on the same screens you and I can see. That's why this Tennessee project matters. The Clarksville smelter is not just a factory. It's a defensive valve in that hydraulic system. It is designed to intercept the ore before it can be turned into refined metal in Asia, before the atoms can be magnetized by the higher bid in Shanghai. Latin American concentrates that used to sail west across the Pacific to Chinese smelters will now be pulled north into a closed loop. Mines in Mexico, Peru, maybe a post-conflict Venezuela, up through the Gulf and Mississippi logistics spine, into Tennessee, and straight into Pentagon-controlled stockpiles. Think of this as tectonic plates under the financial system. For decades, the Asia processing plate was sliding quietly under the Western finance plate. No one cared. It was efficient. It was cheap. But once you weaponize exports on one side and nationalize processing on the other, that subduction zone locks. Stress builds. The earthquake is the price. Tonight, that quake is starting in Shanghai. Now, let's talk about the most ironic player on this board. Because the entity arranging a big chunk of the financing for this smelter, the escape pod from the paper system, is none other than JPMorgan. Yes, the house architect of the paper-silver casino. For 15 years, we documented their spoofing, their concentrated short positions, the way they used COMEX like a pressure release valve for the dollar system. We called them the enemy, correctly. But the house does not survive by being stupid. The house survives by front-running the end of its own game. If you are sitting on the largest short position in the history of a metal, and you suddenly agree to help finance the largest physical smelting project that metal has seen in half a century, you are not staying the course. You are abandoning the casino and buying the building next door that actually holds the vault. Here's how JPMorgan sees it. In a world where silver trades at $80, $100, $200 an ounce, a naked paper short is lethal. The higher the price goes, the more your liabilities explode. But if you control flow instead of price, the math flips. If you help finance the smelter that processes the concentrates, write the trade finance for the shipments, and structure the offtake agreements, you stop being short silver, and you become toll collector on the silver highway. You do not care if the toll is $10 or $200 per ounce. You get paid on volume, on access, on optionality. That is why this deal is not a bet on low prices. It is a confession that low prices are unsustainable. JPMorgan is not doubling down on paper. They are hedging against the death of paper that they themselves engineered. They are watching Shanghai print 82 while New York pretends it's 75 and saying, "We are not going down with this ship. We are buying the lifeboats." Meanwhile, China has executed its own move. On January 1st, Beijing pulled the trigger on a new export licensing regime for silver. Not a rumor, not a think tank report, a formal system that now puts government gatekeepers between 60 to 70% of the world's refined silver and the rest of the planet. If you want that metal to leave China, it now passes through a political filter. So let's stack the timeline. Mid-December, the Pentagon signs on to a $7.4 billion smelter in Tennessee and takes a 40% stake. January 1st, China weaponizes its silver exports behind a licensing wall. January 5th, Shanghai screams $82, while COMEX tries to hypnotize you with 75. Do you really think these are independent events? Or is this exactly what a resource war looks like in the opening phase? The United States looked at its stockpiles, looked at its dependence on foreign processing, and saw a munitions factory trying to run on IOUs. China looked at its industrial base, its solar ambitions, its electronics, its defense needs, and decided to put a choke collar on outbound silver. Both sides came to the same conclusion. Physical is king, and the rest is theater. And here's where the math bites the paper system. The Clarksville complex is expected to be fully operational around 2029. And that gives us roughly 3 years of open-air disconnect between a weaponized East, a panicked West, and a smelter that does not exist yet. 3 years where the arbitrage vacuum keeps sucking metal east. 3 years where every ounce that is not locked behind a military fence is up for grabs. If COMEX keeps the price artificially low during that window, the West bleeds its remaining silver to Shanghai. If COMEX allows the price to rise toward the real bid, the dollar illusion breaks and the inflation lie goes with it. That is the trap. That is the hydraulic lock. So what does the system do? It does what it always does. It lies with the number and tells the truth with the concrete. In public, they issue reports downplaying silver. They talk about speculative excess, about overbought conditions, about how $75 is already too far, too fast. In private, they pour concrete in Tennessee. They sign export control decrees in Beijing. They write project finance term sheets in New York. They are not arguing with us anymore. They are quietly validating everything the silver squeeze community has been screaming for 5 years, with billions of dollars in irreversible capital. Let's bring this down to your level. You cannot build a smelter. You cannot flip a switch on Chinese export law. You cannot nationalize a zinc refinery. But you can do one thing the Pentagon, JPMorgan, and Beijing are all desperately trying to do in their own way. You can get closer to the atoms. Every bar, every coin, every ounce of physical silver you can actually hold is an ounce that cannot be rehypothecated 10 times over on comics. It is an ounce that cannot be quietly diverted into a missile program or a satellite cluster without your consent. And here's a little detail most people will miss. Korea Zinc is not some theoretical startup. It already produces multi-9 fine silver bars registered on LBMA, TOCOM, and COMEX. Its metal already feeds some of the most respected private mints in the world, including Scottsdale Mint, whose own leadership has openly said they use heavy volumes of Korea Zinc silver in their products. So when you're holding a Scottsdale bar or a coin sourced from that ecosystem, you are not holding trinkets. You are holding the same quality of metal that the Pentagon is now trying to lock behind a 40% ownership stake. Think about the arrogance of the messaging versus the reality of the behavior. With their mouths, they tell you silver is volatile, risky for speculators. With their hands, they write a $7.4 billion check and hardwire themselves into the refining stack for the next 30 years. If silver were truly abundant, if the supply chain were truly resilient, if the spot price were truly reflecting reality, they would simply buy on the open market as needed. They are not doing that. They are building a fortress. So when you see the paper price smashed next week, and you will, remember what is actually happening. The smash is for the chart. The smelter is for the atoms. The volatility on your screen is theater designed to shake physical out of weak hands before the system fully admits what Shanghai has already priced in. Prepared investor, this is where you decide what reality you live in. You can live in the paper matrix, where a committee in New York tells you what your metal is worth, while the real stuff is siphoned into military stockpiles and Chinese industrial parks. Or you can live in the material world, where you measure wealth in atoms, in ounces, in what you can actually withdraw, touch, and transfer without asking a counterparty for permission. The Pentagon has shown you its hand. JPMorgan has shown you its hand. Beijing has shown you its hand. They are all converging on the same conclusion. In the next phase of this crisis, the only wealth that matters is the wealth you can pick up off a loading dock. So no, you do not panic sell into this. You do not get shaken out by a red candle on a broken COMEX chart. You zoom out. You watch the cranes going up in Tennessee. You watch the licensing decrees in Beijing. You watch the Shanghai price, not the Wall Street narrative. You hold your line. You keep stacking within your own risk tolerance. You refuse to fund the paper game that is actively betraying its own rules. Because every time they tell you silver is overvalued, they are in the background writing another check to secure more of it. If they are not selling, why should you? This is John A.G. from Currency Archive. The government has officially joined the bid for your metal. They have moved from words to ownership. Now it's your move. Hold the line. Like, subscribe, and share this with the one friend who still believes the spot price on their phone is the truth.